Roy, and I'm very excited to be hosting this discussion today with two experts in the field. So I'll ask Johann and Tuli to introduce themselves. Tuli is one of the senior members of our transfer pricing team, and Johann is our subject matter expert. And we are here today to try and explain in normal human terms what on earth Pillar 2 is all about. And Johann, I love talking to you about Pillar 2 because you're one of the only people who actually try to break down Pillar 2 into simple terms. And I think especially over recent years and months, there's been so much discussion around Pillar 2. So it's timely, I think, to have a sort of sensible discussion of the topic. So Johann, can I ask you to introduce yourself, and then Tuli, please?
Can you hear me?
Yeah.
Okay, great. So my name is Johann Müller. I work for myself. I've been doing a little bit of everything everywhere, in the sense of having worked in Amsterdam and London and New York and in Denmark. I've been with started my life in advisory firms, then went in-house. I worked for the Danish Competent Authority on transfer pricing as a case handler for a while, and for the past 6-7 years now, I've been working for myself. I do interim work with companies whenever I can. So if a head of transfer pricing or something like that leaves, I fill in until they have a new one, or a head of tax or something like that. I do a lot of online training, international tax transfer pricing, Pillar 2, and practical transfer pricing. And I do a little bit of IT in the sense that I help groups to convert their CBCR files and in the future their Pillar 2 files into XML files, and then I help them to upload those files to wherever they need to go. And in that process, obviously, you need to understand also a bit of how to collect the data, where to put it, and do a pragmatic approach. You know, most people just want to get this done and do it as quickly as possible. So that's what we try to do.
Good, and I think pragmatic is really the aim of the game here. That's also our view with anything to do with tax. So Johann, you're based in
Copenhagen.
Copenhagen. So I'm based in Mauritius. Johann is in Copenhagen, and Tuli is in South Africa. So we're a nice tripartite group today. So Tuli, tell us a bit about yourself.
Some jealousy at your screen, which says 32 degrees Celsius. Mine is going from 5 down to 3, but okay.
Thanks, Keelan. So my name is Tuli. I'm a senior manager in the Regan van Roy transfer pricing team. I started out in external auditing at PwC, so I was there for 5 years. Thereafter, I joined transfer pricing still within PwC as well, and I've worked in-house at a South African based multinational pharmaceutical entity. I worked in the group tax team there, and thereafter I reignited my passion for transfer pricing, and I joined Regan van Roy.
Great, thank you. Okay, guys, well, let's jump into the agenda. So this is what we're going to cover today. We're first going to look at the macro situation regarding Pillar 2. So I've been working in tax for 25 years, and it seems like the last decade I've been hearing all about OECD, Pillar 1, Pillar 2, Globe, and then even worse acronyms. So what we're going to start with is kind of remind ourselves how we got to where we are now, what happened to lead us here, what is the timing, and what actually is Pillar 2 trying to accomplish. Then we're going to jump into more of the detail of Pillar 2. And then we're going to look at country by country reporting, just remind ourselves what that is and how it relates to Pillar 2. Then we're going to look at the big picture. So in 20 years' time, how do we think Pillar 2 will have impacted the world of tax? And then we're going to think about what should we do next. So people who are thinking about Pillar 2, who have to worry about Pillar 2, what is it they should be thinking and planning and prioritizing in the next couple of years? So Johann, I am going to start with you with the unenviable task of trying to paint the picture of Pillar 2. As you know, one of our taglines at Regan van Roy is telling people all they need to know about something, but no more. And I think there has been so much broad discussion around Pillar 2 that a lot of non-tax professionals really have no idea what it is. And even a lot of tax professionals are kind of lost with all of the detail that's around there. So are you okay to try and paint a picture of the background, the history, the context of Pillar 2 and what it's ultimately trying to accomplish?
Absolutely. Yeah. So good. Let's talk. So let's talk Pillar 1 and Pillar 2 together, because we even though we focus on Pillar 2, we just need to give a little bit of background on the two together. If we look at the picture on your left hand, you see an M&E. Let's make this real. Let's pretend it is Facebook. And Facebook has a turnover, or at least they had in 2020, of pretty close to $30 billion. Now, if you are above 20 billion in turnover, then you are in Pillar 1, right? And what does that mean? If you think Facebook, they're selling your information basically, and they're doing a bit of advertising and stuff like that, but they don't have to be in a country to make a lot of money, yeah? But they do use things in that country in order to do it. I mean, take simple things. If people don't go to school and they can't read, Facebook is not going to be successful. If you don't have electricity, roads to deliver stuff, safety, etc., Facebook is not going to make money in your country. So there is a whole infrastructure that they rely on in order to have a market, in order to make some money. So countries said, we're tired of these digital companies making lots of money in our country and not contributing towards the infrastructure that we provide them, right? So the idea now is to take the most profitable, largest companies in the world. We're going to start with a small number so we can fix the rules, and then we'll roll it out to the smaller ones. And we'll say, if you have a turnover above 20 billion euros, and if you have a return on sales of more than 10%, we'll take whatever is above 10% and we will tax that, right? So we will then say, let's say that your return on sales is 30%, yeah? Then 10% is for you. We don't care about that because that's a routine profit that most entrepreneurs are expected to make. Quite high, but still it's good. And then we'll take the other 20% and we'll say 1/4 of that. That other 20% is related to intangibles. It's a good brand name. It's amazing coding, etc. But 1/4 of that 20%, or 5% of that, relates to a local marketing intangible. It is your customer base. It is, you know, all the things that are needed to make money locally. And we're going to tax that. We're going to allocate that income to that country, and they are going to levy tax on that. So let's say Facebook had 30 billion, they had 10 billion in profits. 10% of that goes out. So we're talking about 9 billion, and we now need 25% of that. I'm a lawyer, I cannot do math, but let's say it's about 2 billion, right? And little Denmark has 1% of Facebook's global sales. So out of that 2 billion, Denmark is now going to get 1%, or 2 million or 20 million, I don't know. Again, lawyer cannot calculate. 20 million is going to go to Denmark, and Denmark's going to say, you know, in Denmark, the effective tax rate is 22%. So we're going to tax you on that 22% of 20 million, and you need to pay tax on that. If you already have something in Denmark, we'll give you a credit for that, and you need to pay the difference. But in this way, countries where digital companies have no presence will actually get a part of what is seen as a fair share. There is, as you can see, there are a number of de minimis thresholds, such as the 10%. There's also, if you've sold for less than 1 million in a country, you don't need to pay this tax. There is an addition if you are a country with a GDP of less than 40 billion. It needs to be less than more than 250,000 that you've sold in. So all those things are there, but the big question is Pillar 2 going to happen at all? Because there is no Pillar 2 yet, and the one thing we do know it's coming is Donald Trump, right? A lot of people speculate and say Pillar 1 is not going to happen. The question is, what is the alternative? The alternative is that every country in the world levies a digital service tax. And they don't have a 20 billion euro threshold, and they simply levy it on your gross turnover instead of 1/4 of your residual profit. So it'll be a little silly for the US not to adopt Pillar 1, unless they expect they can bully countries into not applying the rules, right? But the digital service tax rules, so withholding tax on Facebook sales and Uber sales and all those kind of sales. That's Pillar 1. We're done with it. We're hardly going to touch it anymore today. Pillar 2. Picture on the right. Imagine you've got on the top right-hand corner, you've got a German company, and they are held on the left-hand corner by a US company, and Germany is paying 10 million or 100 million in interest to Switzerland. And Switzerland is taxing this interest at 4%. Now, the new rules on the Pillar 2 says that every country in the world where you are doing business, you must pay at least 15% tax. So in Switzerland, you're only paying 4%, and now we need to get 11% from somewhere else. And the question is where and how, right? And when the OECD makes rules, they make rules with backup rules and backup rules and backup rules. So there's a plan A, B, C, and D. So the first plan would be for Germany to say, well, since Switzerland is only levying 4%, I'm going to levy a withholding tax for the difference between the 4% and 9%. And that is called the subject to tax rule that will be plugged into the German-Swiss treaty, and then they will pay that tax. In case Germany is not doing it, Switzerland gets another shot at it. Switzerland can say, okay, so 4% is a little low. We also have a domestic minimum top-up tax, and we're going to say, you know, everything that's below 4%, we will levy another 11%, so we get the money. Yeah, and this is called a DMTT, and if it is a qualified DMTT, we call it the QDMTT. We'll talk about that later again. In case Switzerland doesn't do that, the backup of a backup is that the US must then go and say, okay, I will include this income in my income tax return in the US, and I will in the US pay the other 11%. But now you can imagine, again, Trump coming, the US say, we're not going to do Pillar 2 either. And the question is now what you do. And then you've got the final backup, and this is the UTPR, the under tax payment rule or under tax profit rules, where the payment that was made to Switzerland is under tax. And now everyone in the group gets shot at that. So everyone in the group can say, okay, we're going to tax our part of that 11% that needs to come. So imagine that we said that Germany paid Switzerland 100 million. They only tax it with 4 million. There's 11 million missing, right? So now the question is, how do we divide that? And Germany and Switzerland or Germany and the US, of course, Switzerland is not playing along, each have let's say 1,000 employees each, so that's 50-50. And if you look at their assets, Germany has 10% of the tangible assets what the US has. So now you're going to say, okay, out of this 11 million, 5.5 million, we're going to share 50-50. So I get 2.75 million of that, right? And the other 5.5 million, I only have 10% of the assets of what the US has. So I'm going to be able to get out of the other 5.5 million, I can only levy a tax on the other 550,000. And the US is supposed to do that. And if they don't do it, they don't get the money next year, I will get it. So that's how Pillar 1 and Pillar 2 on a big picture scale would be working. There is also a small text there talking about amount B. When the OECD throws out sticks, these are sticks, they also throw in a carrot. And the carrot is amount B. So if you think about most multinationals, let's say you've got a medium-sized multinational with 50 in 50 countries. They maybe have 3 or 4 manufacturing plants, but they have 44 distributors, because you always have far more distributors than you need manufacturing plants, right? And when you do transfer pricing, you always must go for the benchmark. Everyone wants to do benchmarks. These things are expensive. The advisors want to earn a share. The companies that provide the databases want to earn a share. Everyone wants to earn a share. And what the OECD says, we're going to cut this compliance cost. We're going to give you margins, if you have a distributor and they distribute physical goods, if you give us a margin of somewhere between 3% and 11% return on sales, you follow amount B, you'll be okay. You don't need any benchmarks. That will be your distributor, if they are low risk, will be deemed to have earned the transfer pricing income that they should be earning. And that is pillar 1 and pillar 2 in a nutshell. I don't know if you have any questions or comments about that.
Well, that is a nice summary, Johann. Thanks. So what I'm hearing is that basically, in a nutshell, pillar 1 and pillar 2 is the OECD trying to tax the digital economy in a fairer way. Is that right?
Yeah, absolutely.
Cool. And can you just give a big picture summary of the timeline? Like, when did all this start? I can't remember now when I first heard of pillar 1 and pillar 2, and when has the momentum started? And it's interesting what you say, that we don't even know now with Trump coming in if either pillar will happen. So can you give some context to the expected timing of next steps?
Well, there's a long and a short version, right? It all started in '98, you could argue, but actually, arguably, it started when the UK politicians told Google, we're not saying you're illegal, we say you're immoral because you make all this money and you don't pay tax, right? And out of that stemmed BEPS, or the Base Erosion and Profit Shifting Plan, which the OECD worked on from 2012 to 2015. They had 15 action plans on to fix the global world tax system. And one of them was the digital economy. It was quite an important one. It was Action 1. But Action 1 went nowhere because they said, it doesn't make sense to make rules for the digital economy because the digital economy is the economy. If you're going to ring fence things, you're going to create a mess. We need to make one set of rules for the normal economy and the digital economy. And they made this, and out of that came pillar 1 and pillar 2.
Okay, that makes sense. Okay, so that's the broader context. I'm going to go on to the next slide now, which will then take us into a more detailed discussion of pillar 2. So can I hand back to you again, Johann?
Absolutely. So if we break this down, I mean, the first question is, what is the digital economy, right? And if you think about Facebook and Uber and eBay and Amazon and Netflix, what do these things have in common? Basically nothing. Yeah, I mean, you can buy books and you can buy beds and all kinds of things on Amazon. You can do the same on eBay, but Netflix gives you entertainment. Uber gives you a ride. Airbnb gives you a hotel to stay in. So it really hammers home the idea that the digital economy is everything. But now, what is the problem with the digital economy? The first thing is you've got income with no presence. We talked about that. You don't have a permanent establishment, you don't have a subsidiary, but you still make a lot of money in the country, right? The second problem is you do rely on the local market for infrastructure, as we discussed. And the third one is a lot of the profits that you make here is based on intangibles. It is based on amazing algorithms. It's based on incredible money being put into branding, etc., etc. And how do we fix all of these things? So they said, the solutions for the digital economy comes down to the following. The first one is we need to get away from this physical presence requirement of a permanent establishment or a subsidiary. So what we will do is we will say, if you have more than 1 million of sales in a country, you have nexus in that country. Or the 250,000 that we talked about before, right? And don't make a mistake. I mean, there are about 100 countries which have a GDP of below 40 billion euros. So there's quite a number of those. So if we expand the nexus, so the PE concept to nexus, and we tax local marketing intangibles, that is pillar 1. So that's how we address the digital economy in that regard, right? But now you've got the problem that these companies use Bermuda and Virgin Islands and all these to park all their profits. I mean, US multinationals are very careful. You do not mess with the IRS. But everything outside of the US is a free-for-all. So you would have sales all across the world going from Holland via Ireland to Bermuda, and they wouldn't be taxed there, right? And that's because a lot of the assets on which they're based are intangible, so they move. And then they said, so we need to get a global minimum tax. So we also get the Vanuatu's and the Singapores and the Switzerlands and whatever else you can think of, the Liechtensteins, to pay at least 15% tax. And that's how you get into Pillar 2. And once you've done that, we've got it all covered, right? Now the question is, have we solved tax planning for everyone forever? And the answer is no, right? Because if you are a high net wealth individual, that doesn't happen. It's very interesting to see, for instance, that one of the plans of the UN is to introduce a global minimum tax for high net wealth individuals. And we'll see where that goes in the future, right, under the UN framework. Then you also have MNEs with a revenue below 750 million euros. Those are still big groups. I mean, they can have subsidiaries in 40, 50 plus countries. And they are below the radar because they're not under Pillar 2 and they're definitely not under Pillar 1. And then you have for the MNEs which are above 750 million euros, but not 20 billion euros yet. Yeah, yes, they have to pay the global minimum top-up tax of 15%, but they don't have to worry about paying tax in countries where they don't have PEs or subsidiaries yet. So that's how that, Pillar 1 and Pillar 2 becomes the fix for the digital economy, basically.
Okay, and I see then how they work hand in hand. Okay, interesting. So I see some people are saying the slides aren't moving quickly enough. It's because we're still only on slide 4. Now we're going to go on slide 5, which is starting into the detail of Pillar 2. And guys, we do know this is a pretty heavy topic, so please feel free to raise any questions in the chat. I'll read them out as we go. If there's anything that we're saying that you want to ask about or that isn't clear, please do chip in.
Shall I go?
Yes,
yeah.
Please.
Okay, so I've been saying, if you look at most things that people say about Pillar 2, it is negative, it is complex, it is not good, it's not going to happen. It's a lot of whining. But if you are in-house, you have to get the job done or face the penalties or find another job, right? So that's not a bit of a solution. And I try to see, can we take a step back? And if we put this in the context of what we know already, is there an easier way of looking at Pillar 2? And I think the answer is yes. First of all, there's a big misnomer. In the Pillar 2 jargon, you talk about the globe income of a company, right? And the globe income is a misnomer because what you're talking about the earnings before tax. You're not talking about the profit after tax, right? So let's start by calling globe income the globe EBT, right? So this is your global base erosion income, or your base here, and think of globe as a fictional country. And if you do that, then actually things do not look as bad as people make them. Think about what you know about your normal corporate income tax systems. First of all, the globe system is not that different. You start with your globe income. Your taxes are non-deductible unless you are in Switzerland. It is highly unlikely that you are in a country where you can deduct your corporate tax from your corporate taxable income, right? Countries don't work that way because it's endless gross up calculations. It has a pretty royal participation exemption. So when you hold shares in a subsidiary and you get dividends from that subsidiary, the subsidiary has already paid tax on those dividends. No need for you to pay tax on that again, right? If you sell the subsidiary to someone else, whatever gain you make on the sale of those shares are just future profits of the subsidiary. So again, in most countries, you will say no need to tax that. And Globe says, well, if you have more than 10% of the shares in a company, your dividends are tax-free. If you hold the shares for longer than 12 months, your dividends and your gains are tax-free. So it is quite a good system. As a matter of fact, if you hold the shares for more than 12 months, even if you hold 2%, you still qualify for this participation exemption. So that's a pretty generous system, yeah. And then Globe, like a lot of other countries, apply a global tax system, not purely a territorial system. And if you have a foreign permanent establishment, they will tax the foreign permanent establishment income because you pay tax on your worldwide income. However, they will look and they say, you know, okay, in our country, you pay 15% tax. How much have you paid in your foreign permanent establishment? If you've paid 10% tax in a foreign permanent establishment, you owe us another 5. If you've paid 20%, we're not going to give you 5 back. Forget about that. No one is that generous. But we will, we were not going to tax you anything more. So from that point of view, your PE income, you get a credit for the local tax, and everything is fine. Now, when you look at foreign PEs, different countries have different solutions for PEs that make losses. Most of them nowadays say, not our problem. When your PE makes profits again, you can offset those PE losses against your PE profits. But some of them sometimes say, no, you can bring in the PE losses. Globe does not do that. Globe says PE losses is your problem, not our problem. But Globe does say, we will give you a credit for your deferred foreign taxes. And we'll look at a numerical example in a moment where that really is better than most normal credit systems, right? And then there are some funny things about Globe, such as they treat foreign subsidiaries as PEs. So you also, on a current basis, need to pay the top-up taxes of your foreign subsidiaries if they are subject to a tax of less than 15%. Basically, that's what it comes down to, right? And if you have an affiliate, not a consolidated subsidiary, in other words, you typically have no control, you hold less than 50%. There you simply apply the participation exemption. And then just to make life interesting for joint ventures, we got to do a bit of both, right? You are getting the participation exemption, but if your joint venture, if you have 50% of the joint venture, you do need to pay a top-up tax as well. Okay, so that's how the global tax system works. But then this foreign tax credit on the globe, is it that different from a normal country system? I think not. I mean, first of all, they say we will give you a credit for your foreign taxes, but we're only going to give you a credit if we actually tax the income. If we don't tax the income, why should we give you a credit for the tax that you paid because the other country taxed it? So you cannot do that, right? You also have minimum tax top-up. So you have I've said in the beginning, I said, countries can also say, Switzerland can say, oops, we only pay tax 4% here. We are going to levy the other 11%. We're not going to let anyone else levy that. If they do that, then Globe will give you a credit for this other 11%. So you don't pay 11% twice, right? So that works as well. And then your credits for deferred taxes, you have to pay the deferred tax in 5 years, unless, for instance, you have an asset which is quite normal to depreciate over more than 5 years. Let's take real estate or something like that. But funnily enough, so far, not goodwill. So goodwill is a problem, but anything else, if you have a deferred tax, you can actually you can get a tax credit for that. But if you, after 5 years, you haven't paid the tax, you need to go and reverse your tax return from 4 years before. So that really can hurt you. And you cannot make any provision for uncertain taxes. And the whole idea about the deferred tax and uncertain taxes, they're trying to avoid taxpayers gaming the system, saying this year I'm at 11%. You know what? Let me dream up an uncertain tax position. Let me make a deferred tax position to get me over the 15%. And next year, when I'm at 19%, I'll simply reverse it, right? That kind of game is not going to work under Globe, because you've got to pay it in 5 years or you have. But they also say we understand that not every country follow Globe's rules. So in certain circumstances, we will allow you to twist the Globe rules like you normally would, as if you're paying under their rules. So think, for instance, you've got a participation exemption. Now you're in a country which does not have a participation exemption, and you sell a subsidiary at a loss. Now you've got a loss on your subsidiary already. You get a deduction for that in that country. Now the Globe rules say, look how low your effective tax rate is. You need to pay a top-up tax. That will not be fair. So for that jurisdiction, you can make a 5-year election to say, okay, I want the Globe rules for that jurisdiction not to give me a participation exemption on the capital gains and the capital losses. So now I match the other country and I don't pay a top-up tax. Yeah. So that is some of the other rules. They have some special rules, but then we get into details for things like reorganizations and tax transparent entities. They exempt shipping And then some countries like Latvia and Estonia doesn't tax your profits until you distribute them. And this, of course, brings all kinds of problems with them, and they have some solutions for that. And then they've got some backup provisions, right? If, like we said when we looked at Pillar 2, if Switzerland doesn't tax it, Germany gets the first shot at it with the SCTR, and if Germany doesn't tax it, then the US must tax it with the income inclusion rule. If the US doesn't tax it, then everyone can tax it under the under-tax payment rule, right? So that is what Pillar 2 looks like, or the globe system, if you compare it to a normal system of what we know. And it's not that bad. Let's move to the next slide, because then we can talk a little bit more about a numerical example, unless you've got a question, Caoilfhionn. Yeah.
We have a question here, so somebody has said globe appears to be simple. So that I think means you've done a good explanation of it, Johann. So the question is, if globe is so simple, why have China, India, and the US, i.e. big economies, not come up with Pillar 2 local implementation laws? And I think this speaks a bit to what you were mentioning at the start, but is there anything you can add on that?
I think in the case of China and India, there is also a matter of a wait and see approach to see what other countries are doing. The US, as normally, is difficult, which is kind of strange, because the whole reason why we got into BEPS was because their CFC regimes did not work, right? If they managed to have a proper subpart F regime, we would not be in BEPS at all. And I'm saying the US CFC regimes do not work. You need to understand that the whole Pillar 2 is a glorified CFC rule.
Yeah.
Right? That's just what it is. And the US CFC rules did not work because it was a wonderful export subsidy.
Yeah.
They tried a number of other export subsidies under the WTO. They got hammered back every time. And this one worked for them until BEPS. Will China and India implement Pillar 2? You need to talk about what is implementing Pillar 2. Will they introduce a top-up tax? Maybe they don't need to do it that much right now, because, I mean, even though China is the world's second largest economy and everything, if you look at the number of multinationals that they have a turnover of above 750 million, it's not that many yet, right? Mm-hmm. India, all the same. Will they implement a qualified domestic minimum top-up tax? Absolutely, right? Does India need one? I don't think really India even needs one. India will always be above 15%. If you've done business in India, you know that you pay more than 15% tax. And for China, I mean, where they get hurt is with investment incentives.
Yeah. But
they may very well adopt their investment incentives in such a way that those become globe compliant, right? So instead of saying we'll give you a 200% depreciation on your manufacturing equipment like they used to in the past, now they will say we'll give you a qualified refundable tax credit, coming down to the same thing, except for globe purposes, it counts as an addition to your income. It doesn't count as a deduction dollar for dollar from your tax, which is much better. Yeah.
Yeah. Interesting. Okay, I hope that answered the question. Johann, I'll go on to the next slide.
Okay.
So this is quite number heavy, so hold on to your hats, everybody. And if you have a question, please do shout.
We'll talk through it very, very high level. I mean, the whole purpose of this slide is just to show you how globe compares to your normal exemption regimes and your normal credit regimes for those of you who are doing or have done tax returns in the past, right? So let's pretend that we've got a PE in country A. It buys an asset for 100. Commercially, it depreciates it over 5 years, 20 per year, but it can expense the whole thing in year one in country, in the PE country's jurisdiction. So we're talking the bottom left corner, right? So if you look at the financial accounts, EBITDA of 100, depreciation of 20, EBT of 80, they have a deferred tax of 4, and they have a net income or financial net income or loss of 76, right? Sorry, I just see a blank screen now without any numbers. There we go.
Sorry,
Yeah.
can you see it back? Sorry, I was trying to make it
Okay.
bigger, but it obviously disappeared.
Okay, that's fine. And then the tax return locally, they've got the income of 100 and depreciation of 100, so they pay 0 tax. Now, if we look at the top left slide, at the parent or at the headquarters, right? The first one is, if you look at the financial numbers in the participation, they will have, the PE will have an EBITDA of 100, depreciation of 20, EBT of 80, nothing happens, right? If you look at their tax numbers, when you have participation exemption, you don't care what happens in the other country. Everything is 0, we're done, yeah?
Yeah.
If, however, you look at the foreign tax credit system, what you now find is they've got an income of 100, they've got 20 of depreciation, so they've got 80 in tax, 80 in EBT, but they only pay 12 in tax in their financial accounts. So they need to pay a top-up tax here of 4, which then goes, which they need to pay in the parent country A. Whereas in the globe system, because you can take this deferred taxes and add that to the current tax of 12, you end up with 16. You are in the 15% exemption. You're okay. You don't have to pay a top-up tax. So in that way, I mean, the globe is slightly better than a tax credit system, and it should be, because it is a backup of a credit system, right?
Yeah.
In year 2 and further, we don't need to go through numbers, so you'll just see that everything evens out from year 2 onwards, because the deferred tax goes through the P&L in year 1 and not after that. That's the only description of it that goes with that.
I've got 2 questions, Johann, if I can ask them now.
Yeah.
The first
go on.
one is, how would the CFC imputation of a country be impacted by Globe? And the second one is, where countries are granted a tax incentive in the form of lower tax rates, like for instance in Eswatini, will this need to be topped up, or is there some sort of exemption? So
let's take the first question, the CFC rule. So Globe has some interesting throwback rules. And they say, you know, when you calculate the effective tax rate of your subsidiary, let's say your subsidiary paid out a dividend, and there was a 15% dividend withholding tax on that dividend. That 15% dividend tax, we're not going to add to the parent's tax to see if they are paying at least 15%. We're going to throw back that 15% to the subsidiary, because it really is a tax on the subsidiary's profits. So if your subsidiary have, for instance, a 10% corporate income tax rate, it pays out a dividend, and there's another 5% dividend withholding tax on that. That should get your subsidiary to the 15%, and you don't have to pay any tax. They do the same with the CFC. They say, you know, the CFC taxes that the parent pays because the subsidiary is passive income and under-taxed actually is a tax on the subsidiary's profits. So instead of saying we will add the tax on that CFC with the parent, we will throw it back to the CFC. So maybe they only paid 5%, the parent paid another 10% in CFC taxes. That now gets added to the subsidiary's taxes, and they now are deemed to have paid 15%, so there's no top-up tax, right? That is how you would deal with the CFC rule. So what was the second question? Sorry.
How, when countries grant a tax incentive in the form of lower tax rates, is that topped up?
Yeah, you would need to go and adjust your tax incentives, because the OECD may come with more, but at the moment, the only good tax incentives you want, if you want to call it that, there's one direct and one indirect. The first one is if you give these qualifying cash refundable tax credits, or qualifying marketable transferable tax credits, which means you can sell your tax credits to someone else. The rule there generally is that if the tax credit refund happens in cash within 4 years, then you add it to your income, but you don't reduce your taxes. And if you still are, after you've added this to your income above 15%, you're okay. So let's say you have 100 in income, right? You have a tax rate of 20%, and you got a tax credit of 50. Yeah. you would now have to say, my income is not 100, my income is 150, and I've paid 20 in tax. Now, 20 over 150 is not quite 15%. It is 12.5, if I remember correctly. So that means you're going to only have to pay a top-up tax of 2.5%. It's not perfect, but it's better than nothing, right? A refundable tax credit of 50 on a current tax of 20 is also quite big. On the other hand, if that tax credit is not paid in 4 years, but in 5 years, it does not qualify. And now what you're going to get is you're going to get that you have 100 in income, you pay 20 in tax, you now have to deduct that 50 from your 20 in tax. So you end up with minus 30, which means that now you definitely have to pay the full 15 in top-up tax, right? So you need to do it that way. And then the other investment incentive that there is when you calculate your top-up tax, let's say your income is 100 and you've paid 10% tax. Yeah. So now you only have 10, so you should pay another 5%, right? But the Globe rules say we want to reward companies with substance. So we will allow you a deduction of 10%, it's going down 9%, 8% until you hit 5% over the years. We allow you a deduction of 10% of your total payroll for that country. So let's say you paid 100 in payroll, so you can get a deduction of 10, and we will allow you a deduction of 8% of your tangible assets. So let's say you've got 1,000 in tangible assets, you get another 80, right? So now you've got 90 in what they call a substance-based income exclusion. And you can deduct this substance-based income exclusion from your Globe income, or the 100 that we talked about. So you now end up with only 10 on which you pay 20 in tax. So you're way above the 15%. You do not have a top-up tax.
Okay, wow. Quite complex, although I'm able to follow it, so it can't be that hard. Yeah. We have another good question here. Thank you, guys. So Mohammed is asking, but isn't there a risk of double tax if one country where the UPE implements Pillar 2 and the other does not? And under Pillar 2, which now has allocated the taxing rights of the CFC to the subsidiary, would that not mean there's tax in both countries?
Yes, indeed. But there is a hierarchy.
And that's the next question. So the next question, let me come in here by Stavros. What happens with the ordering? Is it local tax law, then CFC, then Globe? I'm asking because if the QDMTT raises the tax expense to 15%, then maybe the CFC will not be applied. So I think that's what you're going to cover now.
Exactly. Yeah.
Cool. Great questions, guys. Keep them coming.
Yeah. So here's a little bit of uncertainty about this one, but remember, if you look at the political process, the OECD kicked off and went for BEPS and made all the rules, and halfway they remembered, oh dear, we need to talk to the developing world as well. So they built the inclusive framework, and they said to all the developing countries, here's the rules that we made. You do agree, yes? That's more or less how it went, which is why we now have the stuff going on at the UN. But in that whole process, the developing countries said, originally all the taxes were going to be paid at the ultimate parent, and the developing world said, what is this? Where is our turn? And they said, okay, this is wrong. So now the first hierarchy is the STTR. So when we talked about Germany, Switzerland, and the US, Germany gets to levy this additional withholding tax, right? It must happen under a treaty, but the developed countries have agreed that any developing country that asks for an STTR will get the STTR in their treaty. Sorry, but this additional withholding tax on the payment, right? If there is none like that, then the local country gets the first shot. Yeah. So they will levy a minimum top-up tax, and hopefully this will be a qualifying one. And when it is, then no one else can levy, right? Yeah. The parent still must calculate whether there's a top-up tax due, but it will give a credit for the top-up tax, and then there's nothing left to pay, right? And if the ultimate parent doesn't do it, you go top-down. Then you look at the next tier of holding companies, and they must pay it. And if they don't pay it, then they must pay it. And if there's no holding company left, then you go to the under-tax payment rules, and then everyone can levy. So because of the hierarchy, you should not run into double tax.
Yeah. Okay,
Yeah.
good. Hope that answers all the questions. I'll go now, Johann, on to our next slide, which is a beautiful harbor.
Exactly. I mean, if you live in the Nordics, sometimes you just need to see a bit of blue water, blue sky, and some sun. You know, so I thought let's throw in that picture about the safe harbor. So the idea with the safe harbors is that that especially in the beginning. I mean, this is new for everyone. The compliance is going to be hell, right?
Yeah.
Because we need to figure out the rules. We need to find
Yeah.
the numbers in our accounts, etc., etc. So they said we'll give you a bit of a light touch in the beginning. You are already filing the country-by-country reports. We will use the country-by-country reports as a basis to see if it is very likely that you are paying more than 15% already, or that you're so small that no one worries about you, right? If you are one of those, you're out. You don't have to fill in this whole return. We give you a couple of more years to practice. We will turn those safe harbors into permanent ones, but there everything will be a little more complicated. And we don't quite know how to do this because it depends on all the kind of tricks that you're going to try and play with us to game the system. The more you try to game the system, the more complex this is going to be. That's how we work, right? It's called job security. And that's what we need to do. If we go to the next slide, I'll just take you through the different safe harbors.
Can I just share one more question first, which is quite a pithy one. So how is STTR better than QDMTT? Or is it?
STTR is better than QDMTT because the country of whom the tax base is getting eroded is getting a first shot. So the country where you made the tax deductible payment is the first one that's entitled to the top-up tax.
Yeah.
Yeah, but only to 9%, because remember, withholding taxes is on gross income, not net income, right? So they said let's make the cutoff at 9%. Yeah.
Okay, good. Hope that answered that question. Here is your next slide, Johann.
Yeah. Okay. So if we just look at the safe harbors that we have, and why do we call it a safe harbor? Because if you look at the Pillar 2 return, there's one section in which you need to describe the whole of the group, who's holding who and who's registered where and what are their tax numbers and what changes were there. Everyone must fill that in for everything every year, no exceptions, right? But then you get a second section with about 10 questions, let's say, in which you choose which safe harbors you apply. And if you qualify for any of these safe harbors for that jurisdiction, you're done. There's another 100 questions waiting for you in Section 3, but you don't get to Section 3 because you're in a safe harbor. So the attractiveness of the safe harbor is you're skipping 80% of the globe return, right? And I've probably for about 5, 6, 7 groups, I've done some impact assessments on what Pillar 2 will do for them, and without exception, 85 to 90% of these groups, the subsidiaries roll out under the safe harbors. So you're only left with 10%, 15% of the countries where you need to do the whole Pillar 2 return. And my guess is from that 10 to 15%, and we'll come to that in a moment, there's got to be local minimum top-up taxes, which is going to take care of that as well. So maybe you will go through all this theory and all this noise to fill in Pillar 2 returns in 1 or 2 countries. But you're going to have to do all of it in any case, right? Yeah.
Okay.
So if we look at the safe harbors that we have a de minimis safe harbor under the CBCR, which means that if in your CBCR, your total revenue for any jurisdiction was less than 10 million euros, and your EBT for that jurisdiction is less than 1 million euros, you're out. Because no one's going to do aggressive tax planning for 1 million euros only. So you're out, right? The second one is if you are, according to your CBCR already, if you divide the EBT by the let me say this right. You divide the tax by the EBT, and you're on 15%, you're out as well, right? So you don't need to worry about that. And then there's the one where they say, you know, if your income is 0, your effective tax rate will also be 0. We don't need to worry about that. Or it's going to be, depending on how you calculate it, way higher than 100%, right? And remember I said we get the substance-based income exclusion where you get a deduction for your payroll and you get a deduction for your tangible assets. Now, since you can deduct that from your taxable income, not only do you need to look at whether your EBT is 0, you need to look at whether your EBT is smaller than your substance-based income exclusion. Because if your EBT is 100 and your substance-based income exclusion is going to be 150, then you're going to multiply your top-up tax rate 15%, let's say, with 0, right? Or minus 50, because your substance-based income exclusion is bigger than your EBT.
Yeah.
So in that case, you roll out under those as well. So those are the transitional safe harbors, all based on the CBCR. Now, your CBCR must, of course, be a qualifying CBCR, but if you follow the OECD rules, which they've published since 2016, don't worry, you're done. Yeah. And then you get the permanent safe harbors, which the transitional safe harbors are only supposed to apply until end of 2028. And then you must move to the permanent safe harbors. There you may not always be able to rely on the CBCR. We don't know yet because they're still making the rules. But if you think about it, so they want to give you a, right now, if you look at how you calculate your effective tax rate under the full Pillar 2 rules, right? You've got your financial net income, and then you literally have 26 adjustments to make to it to get to your globe EBT. Then you take your taxes, your current taxes in your financial accounts, plus your deferred taxes, and then you've got another 42 adjustments to make before you get to your globe taxes, right?
Wow.
Now they want to reduce those numbers from 26 to maybe 6, and from 42 to maybe 6 or 7. But you see the problem here, right? The moment they make the rules and say you don't have to worry about the other 20, everyone is going to game the system and going to try and fool around with it, right? To get out of the 4 and into the other 20. So that's why this is taking so much time. You know, the people complain about the complexity about Pillar 2, but there's 2 things which causes the complexity. The first one is we want the rules to be simple, but I do need this exception for me.
Yes.
And that's going to create complexity, right? And then the second one is as soon as they make a rule, some advisor, sorry, we're all in the game, publishes a clever idea how to get around the rule, and then they need to make a block for the clever idea, right? So whatever complexity it is, you brought it on yourself. Know, it is part of the cat and mouse game. And like I said, you think of it as job security, and then you feel more positive about it.
It's a good way to look at it.
Those are the permanent and the transitional safe harbors. There is the QDMTT. So if you have a minimum top-up tax, and it is a qualifying minimum top-up tax, so in other words, it follows the globe rules pretty much point for point. Then once you've calculated and paid your domestic minimum top-up tax, and remember that's going to be a local tax return, that's not going to be a global return, then you can simply say, okay, I have already paid the top-up tax that I need to pay. And again, you stop at section 2 of the global return. You don't need to go to this monstrosity of section 3. And then the transitional under tax payment rule is basically a rule for the US only applying for 25, where they say, you know, you don't end up in this scenario where everyone must pay something if you don't have a income inclusion rule. But that only applies for 2025, and most countries don't even have a UTPR for 2025, so it's largely ignorable.
Okay, great. Yeah. We have one more question, which is an interesting one. We are seeing countries trying to give back the additional tax collected from Pillar 2 to multinationals in the form of other incentives which are not hit by Pillar 2 regulations. Now, I'm not sure what countries this person is referring to, but given that, could we say that Pillar 2 achieves its objective or not?
Yes, it does. because those countries are not going to get away with it. I know that there's been
Okay.
some countries, I think Vietnam was one, which tried to give, either give it under the normal rules and they implement QDMTT, but they can't give it under the QDMTT rules, or they try to give it under the QDMTT rules. And countries are creative. I mean, they levy the QDMTT from you, but then they give you an investment incentive equal to the QDMTT or something like that. And the OECD has been very clear, and they said you're welcome to do that, but that's not going to make your QDMTT a DMTT.
Yeah.
You're not going to get out of the rules. There's one country that had a very interesting approach, and that's Malta. Malta went to companies and they said, okay, so we have a global minimum top-up tax. In Malta, you've got this weird system where you pay 30% tax, but then you get it all back as soon as you dividend it out, right? Or most of it back. And Malta said, where do you want to pay your top-up tax? Do you want to pay it in Malta, or do you just want to pay it at home? And most multinationals said, you know what, if we're going to have to file tax returns in any case, for God's sake, save us the hassle of doing another QDMTT return. We'll just pay the top-up tax at home and be done with it. So Malta deliberately went and not implemented a QDMTT because that's its way of saying taxpayer friendly. But the other ones, until the OECD has said that your domestic minimum top-up tax is a qualifying one, you can plan everything you want. It's not going to work.
Okay,
Basically.
interesting.
Yeah.
Cool. And the question was actually referring to Vietnam, so that was well guessed.
Yeah.
I'm trying to make the slides bigger. Is that working? Okay, it's hopefully going to work because I understand it is a bit small. So is that looking better? I'm going to now go to
Yes.
Yeah. Sorry, guys. So, guys, we are now going to talk about country by country reporting. So Johann has painted a very clear picture, thank you, of the broader Pillar 2 framework. And now we're trying to look at, so remind ourselves what country by country is and talk about how that interacts with Pillar 2. So Tuli, over to you.
Thanks, Caoilfhionn. So we'll just start, like you said, just with a very quick recap of what country by country reporting is. So it's one of the components of the OECD's three-tiered approach to TP documentation. So the first two being the local file and master file. It's basically just a reporting system for large MNEs with an annual consolidated group revenues of 750 million euros. So it's the same threshold as Pillar 2, which Johann mentioned earlier. It was developed under BEPS Action 13 guidelines, and its intended purpose was to increase tax transparency amongst MNEs by requiring them to disclose key financial and tax metrics for each country or jurisdiction that they operate in. So it was really developed as a tax risk assessment tool that would try to promote fairness, transparency, and accountability within global taxation. So together, CBCR and Pillar 2 are envisaged to enable tax authorities to enhance compliance, reduce tax avoidance, and to ensure fair global taxation. So that's just on a very high level. And then we can go to the next page. Thank you. So when we're looking at what the link is between these two mechanisms, so if we're talking about transparency and tax-based analysis, so firstly, looking at Pillar 2, like we've said, it establishes a 15% global minimum tax rate in order to curb profit shifting to the lower tax jurisdictions. And in this, CBC plays a pivotal role in evaluating the profit distributions and identifying which of the jurisdictions the MNE falls below the minimum effective tax rate is. And Johann mentioned it earlier that you can take the profit or loss before tax from your table 1 of your CBCR and divide it by your income tax accrued. So that'll give you the effective tax rate, and then you'll be able to see how you fare in relation to the 15%. So it ensures that tax authorities can then enforce Pillar 2 effectively where there are any gaps in tax-based allocations. So like we said on the CBCR side, it equips the tax authorities to detect any potential BEPS risks by highlighting the mismatches in profit allocation relative to economic activity. So what that means is, say, for example, you've got a typical low tax jurisdiction. They've got high profit before tax that they're reporting on their CBCR. However, they've got a low number of employees, people on the ground in country. Maybe they've also got a low value of tangible assets, low value of taxes being paid. So that's kind of ringing alarm bells that there could be substance issues there. And so that works with Pillar 2. And then if we go to the implementation of the Pillar 2, if we go to the risk assessment. Sorry, Keelan, I think we've moved.
Sorry.
Can we just go back? Yes, sure.
I'm too keen.
If we look at the implementation of the Pillar 2 rules, so under the GLOBE rules, Pillar 2 includes the income inclusion rule and the UTPR, and these rules require precise data of the MNE's global operations, particularly, like we've said, the effective tax rates to enforce the 15% minimum. So CBCR works as a data source that can be used. So while Pillar 2 has its own reporting framework, CBCR provides the critical foundational data, including the income and taxes paid in each jurisdiction, like we said earlier. And then this data supports the accurate calculation of the effective tax rates under Pillar 2. Then we can go to the next slide. And then I'm actually just going to start with the risk assessment and enforcement. So under Pillar 2, we said it uses the CBCR data to implement the GLOBE rules, ensuring that the MNEs meet the 15% global minimum tax, and the tax authorities can apply the IIR or the UTPR to address any shortfalls. And then CBCR provides tax authorities with a comprehensive view of the MNE's global financial activities, and that helps in the risk assessment and helps to identify any anomalies, like we mentioned earlier, profit concentrated in low tax jurisdictions, which signals potential tax mismatches or aggressive tax strategies. And then if we look at the harmonization of the compliance requirements, both CBCR and Pillar 2 reporting frameworks are designed to streamline the tax compliance for MNEs by promoting standardization and try to reduce any administrative complexity. And many of the jurisdictions are aligning or expected to the Pillar 2 rules with the CBCR framework in order to minimize duplication of reporting requirements. So, for example, we know under CBCR, when CBCR kicked in, many MNEs may have put in place, systems or enhanced their existing financial systems to try and be able to extract the CBCR data effectively and correctly. So that's not going to go to waste. I think there are ways in which to overlay the requirements of Pillar 2 onto the existing CBCR systems. So the MNEs can leverage off that data and those systems without much more, not say any, but without not a lot more additional requirements.
That's
so
great
that helps. Yes.
So the CBCR work can be a base almost for what's required under Pillar 2. Great.
Yes, exactly. So this reduces any compliance burdens, and it also enhances efficiency, I think, for both the tax administrations and the MNEs. Yes.
Yeah. Great.
And then going to the next slide. So just in summary, basically, the benefits, like we just said, CBCR is a foundation for implementing Pillar 2 and the global minimum tax. They use similar data points. In terms of transparency, they both are trying to provide a clear view of an MNE's global tax footprint. And then in terms of consistency, they standardized data. It simplifies the compliance with the Pillar 2 rules, and it reduces admin burden for both taxpayer and the M&E. And also, lastly, it encourages global cooperation amongst the tax authorities.
Great. That's very interesting to see how they really work hand in glove, Pillar 2 and country by country reporting.
Yes.
We've got an interesting question that I'm going to answer first, and then I'll ask you, Johann, to come in. It's basically about whether businesses should implement Pillar 2 themselves. So Altaf is saying that they attended a Pillar 2 webinar by PwC, and there was a question as to whether M&Es were going to implement Pillar 2 themselves or outsource to a consultant, and the majority said they wanted to implement themselves. So the question is just what we think of that. I definitely think that's the way to do it. I am a consultant, obviously, but I've spent about a third of my career now in-house, and a big part of our role at Regan van Roy is to empower tax teams to do things themselves rather than give up ownership to consultants. So I think that Pillar 2 is such an important part of the tax landscape of any M&E, and I would really recommend that it be taken in-house and understood as well as possible upfront, and driven by the internal team rather than outsourced to a consultant. I think it's way too important to outsource. Johann, I'd love to hear if you agree. You're on mute.
I had to laugh. You know the answer already, but
yes,
I absolutely agree. And let me give you a little bit of background. I mean, you know, unless you're going to have a system that bolts directly onto your ERP system or your consolidation system, you're going to get a form, and whoever gives you the form is going to say, please just fill in the form. Now, the problem with please just fill in the form is that is 90% of the work.
Exactly.
Yeah, because you're going to have to decide which accounts go into which boxes and all that stuff. And I mean, you. So from that point of view, that's not the role of the advisor. The role of the advisor is to help you understand the rules, to help you understand where which account goes and stuff like that, right? And to give you some practical examples. So I've made a tool that I help companies with in and I give it to them, and then if they want me to help them, I help them fill them in, and ultimately we convert this thing into XML and file the Pillar 2 return. I'm doing that already for CBCR, so there's some experience there. But you know, the practical things are, I mean, I spent 2 days helping a company match their company names. It's quite a large group. They've got way over 200 subsidiaries. They pull their sources from 4 or 5 different sources of data, and every source, they don't use one unified company number in all of them. Every source spells the name just slightly different. Sometimes it's BV, sometimes it's B.V, sometimes it is comma corp, sometimes it is no comma corp, otherwise it's comma corp with a dot, and then sometimes with brackets, formerly known as blah blah blah. Good luck with sorting all those names. And you know, why would you pay a consultant 200, 300, 400 euros an hour to do that sorting for you? You need to do that, right?
Yeah.
Then you can discuss the accounts. You can take your chart of accounts, and here's a challenge to those of you who are in-house: get acquainted with your chart of accounts so you know what's in there, right? And then you can pick what goes under which boxes, and then you can fill in the tool. And obviously, when you do the return, whatever you choose to do it on, if you're doing it the first year and it costs a huge amount of time, and you do it in the second year and it's costing the same amount of time, you're doing something wrong.
Yeah.
Because you need to do it in such a way that the second year is 20% of the first year. So for instance, I mean, I'm an Excel guru. I'm not guru, dinosaur. Sorry. I always get dragged into conferences to talk about Excel instead of whatever, OneStream or whatever else, right? But you when you pull your data, for instance, from HFM or from Cognos Controller or so, you make all your variables in the left, you put all your companies row by row, and you put all your account numbers across the columns. And in theory, if you don't have any new accounts, you don't have any new subsidiaries, so you haven't sold anything, you haven't deleted any accounts, next year when you do your Pillar 2 return, you should change 2412 to 2512. And then you're doing it right? So we very much say companies should do this in-house. They know their facts and circumstances best. You may have a weird account. I mean, I was in a shipping company. We have a lot of port taxes. When we looked at our port taxes for the first time, we got the shock of our lives. We never knew we paid so much in port taxes. We didn't. Port taxes, no one knew what port taxes was, so it became the trash can for group accounting to dump whatever they wanted into it. Only you can discover that. No one externally has got to do that for you.
Yeah.
So hopefully that answers the question. Yeah.
I totally agree with that. And this question of when to use consultants and always reminds me of the fact that I am no longer able to turn on my own television. My kids now are the only ones who know how to work the various remote control systems, and it's completely disempowering. So when anyone uses consultants, they should use them to empower and build capacity, not to give away power and to create reliance. And for me, having to call my kids downstairs to switch the channel, that means I'm completely reliant on them. That's a bad consultant behavior, rather than just getting them to teach me how to do it myself. Anyway, I'm just looking at the time. So we have gone through all the detail of the discussion. Now I'd really love to get your thoughts, Johann, on if we're to look back in 20 years' time, how do you think Pillar 2 will have changed the tax landscape? Like when it's all settled down, what do you think its impact is going to have been?
I would be as bold as saying if we look at 2029 or 2030 and we look back, we will see that very few multinationals pay top-up tax under the IIR or the UTPR rules. What we will see is that the globe has come, or the world has come, to a minimum tax of 15%. And if we look at this slide, I think we can just do the next, all the boxes on this one. There's 4 boxes on this slide.
Oh, yeah. Sorry, it's...
No, that's fine. So if you look Europe, for instance, not every country has UTPR yet. They all have the income inclusion rule because there's a European directive that says that they must do it. But they all have a local top-up tax as well, right? There's something like I don't mind giving tax incentives to my taxpayers, but if you're going to tax the difference, forget about it. I'm going to tax the difference, right? So they all are implementing. Europe, you can see all of them do this. If you look at when we get to Asia Pacific, these countries, they may not all have a UTPR. Very few of them do. I'll just talk you through the slide while we're getting there. But most of them have a QDMTT, or they are making a QDMTT. If you just press the arrow, it should give you.
Yes.
There we go.
Sorry,
yeah.
Took me a while to figure out.
No problem. Yeah. So Asia Pacific, a number of countries have implemented QDMTT. A lot more of them are considering it. I think Africa and the Americas probably speaks the clearest, where countries may not have the capacity to do the complexity of the income inclusion rules and the exchange of the data and all that stuff. But they say, you know what, no one's going to kill our tax incentives by levying the tax for themselves. We can use that revenue. We will make a top-up tax. So you can see more and more countries are doing this. And I think if you look at this in 2029, 9 out of 10 countries will have a QDMTT, right? So you will pay your top-up taxes locally, which means the world would have moved to a global minimum top-up tax of 15%. In the countries where you don't have that, let's say India doesn't play ball, you are paying more than that. In any case, you will have an effective tax rate way above 15%. You roll out under the safe harbors. So maybe you're going to have to file an income inclusion rule tax return for Vanuatu. And that's got to be it, right? If you don't roll out under the de minimis safe harbor already. One thing that's just interesting about the QDMTT is, and it's a little concerning, is the Pillar 2 return you're going to make under your group gap, basically. So it's going to be, 9 out of 10 times US GAAP or IFRS, right? For the domestic minimum top-up tax, countries can choose between the group GAAP or the local GAAP or both. And there are a number of countries which bring in local GAAP, which is a pity, because they say we cannot expect our tax authorities to learn 60 different GAAP systems. But that is, of course, that's not a well thought through argument.
Yes.
Because 90% of those GAAP systems are going to be IFRS or US GAAP. So you don't need to learn 60, you need to learn three. Your own US GAAP and IFRS. And there are more and more harmonizations across these systems year after year after year. It is a pity that for local administration's sake, some countries are picking compulsory local GAAP, because then you need to take that extra hurdle of showing when you file your Pillar 2 return that your local GAAP is indeed a acceptable GAAP, right? But that is just another point. But 8 years, 10 years from now on, we're all going to pay local top-up taxes. Our Pillar 2 tax returns are going to be pretty small because 99% of it's got to stop under the safe harbors.
Okay.
Yeah.
Makes sense. Sorry.
Very quick.
Yeah.
Because I'm aware of time. So I just wanted to take you through a high level of when we talk so much about facts, what does this look like in numbers? And I'm going to take you very quickly through. So let's say we've got our structure on the left. We've got a Danish ultimate parent company. It has a subsidiary that holds all the Latin American companies in state C, and it has a finance company which holds one subsidiary in state C. But this finance company has more than 20% external investors, right? Either a venture capital fund or whatever. Now, under the Pillar 2 rules, they want to collect the maximum top-up taxes that they can. If Denmark was to pay the top-up taxes for systems, it would only pay 80% of the top-up tax because it only holds 80% of systems shares, right? So when you come to a partially owned parent entity, which breaks down to the wonderful acronym of POPE, so if you have a POPE in your group, your POPE is going to pay the taxes for you because the POPE is holding 100% of systems. So it can pay 100% of the taxes, right? So if you imagine what country C's globe return is going to look like. Now, first you need to calculate the EBT under globe. So the globe EBT or the globe income, you're going to start with your net financial result, which is 100, 100, 100 for everyone here. So you end up with 400,000 in the far right, top right. You're going to add back the tax because we don't gross up on that. It's going to be another 20. You're going to add back all the fines that you cannot deduct. Most country systems have some kind of, you can't deduct bribes, you can't deduct fines, all that kind of stuff. You're going to add that back. So you end up with 448,000 in income, the globe EBT for that jurisdiction. Yeah. Now you're going to say, how much tax have you paid in that jurisdiction? And it just so happened that every company paid exactly the same. They paid an actual current tax of 5,000. They had a deferred tax of 2,000. And they had because it is a 25% tax rate, when you do your deferred taxes, you need to calculate it at the nominal rate. Now, the globe nominal rate is 15%, not 25%. So if you have a 2,000 euro deferred tax at 20%, and you recalculate that down to, or 25%, you recalculate that down to 15%, you end up, in this case, you need to deduct 800 because your deferred tax at 15% is only 1,200, right? So you've paid taxes of 24,800. Now, if you divide 24,800 by 448,000, you just come to 5.5%. So clearly you need to pay 9.5% top-up tax. But remember, we said you can deduct 10% of your payroll and 8% of your assets from that. So you say, I have 10% of my payroll is 400,000, so that's 40,000. My assets is 1.2 million, so that's another 96,000. So my total substance-based income exclusion is 136,000. I can deduct that from the 448,000 at the top, which was my total globe income. So I have an excess profit of 312,000. So now I need to pay 9.5% top-up tax over 312,000, and that gives me 29,500. But my Pope needs to pay whatever they need to pay, right? So if you look at the 29,000, in this particular case, 7,000 must be paid by the Pope, and the other 22,000 will be then paid by DK UPC. And that then gets you to your 29,000 in total that you need to pay. And that is, and if for instance, for whatever reason, neither Denmark doesn't have a top-up tax, then you come to the UTPR. Let's say that state C has 50 employees right at the bottom, and globally there are 500 that they apply the UTPR, so that's 10%. So out of this 22,000, half of that, 11,000, you can levy 10% of the top-up taxes on that. And then if you look at their tangible assets, my numbers are wrong here, lawyers and numbers, oops. So I have more tangible assets than I have globally. That means I can get 120% of that, and then I end up paying my top-up tax, my UTPR on that. So this is just to give you a very high level of how you would do your calculations per country. And then obviously if you're in 40 countries, good luck. You're going to do 40 of these things.
Wow, this is a great calc. I think I'll need to put a wet towel on my head and go through it line by line, but it does outline it very clearly. Okay, guys, we have 9 minutes left. I would like to ask each of you, what do you think taxpayers should be doing next? So both if we know we're going to be impacted by Pillar 2, or if we think we might be, what should we be thinking about? What should we be prioritizing?
Okay.
Who wants to
Shall
go
I
first?
take the first shot? Yeah. I mean, the first thing is, and most likely, if you are above 750 million, your accountants have been running the door completely out of its hinges, trying to tell you that you must make an impact assessment, right? You must, in your 24 accounts, already say how much top-up tax you're going to pay. So you need to do the whole calculation, basically. So understand what your exposure are, and be practical. Yeah. Try and identify all the countries that qualify for the CBCR safe harbor, throw them out. Yeah. Then go and look at whether you can qualify for any permanent safe harbors. The one nice thing about the de minimis safe harbor permanent is CBCR, you only look at the current year. De minimis, you look at the average of the last 3 years. Now, if you are in a startup position, you may actually already be in your 3rd year and you may be way over the de minimis, but if you take the average of the past 3 years, you might still just be under it. So look at that one, right? If you are in a country that will already have a QDMTT, worry about that. If whatever is left, like I said, your 10% or 50% of countries which are still in Pillar 2, remember I said you need to make 26 adjustments to your globe income and for another 44 to your taxes. The good news is you're not going to make all 26. No group is that complex. Always you're going to add back your taxes, of course. If the company holds a subsidiary, you're going to have to take out the dividends, the capital gains. If you paid fines for more than 50,000 euros, you're going to have to add that back. But that's probably the most likely changes you're going to make, and the other 23 is probably going to not apply to you, right? And the same with the deferred taxes and the current taxes. A lot of those are not going to apply, so you're probably going to make 2 or 3 adjustments, maybe 4 there, and you're done. And then you can go and do your expected impact assessment. That's where I am on this. We talked a little bit about the technology solutions. I would say there are 2 kinds of taxpayers: those who want to see what they're doing and the Excel dinosaurs. There are those who like the black boxes and bells and whistles. If you go for that, there's lots of firms offering that. If you want to do it yourself, talk to Caoilfhionn and me. We can definitely work together, and I'd be very happy to share with you the template that I use. And again, we also convert that at the end of the ride into your XML return that you need to file. And you're going to need to dive a lot deeper then. Yeah. So not this Saturday, but next Saturday, we have a 6-hour course from 10 to 4 in which we're going to talk about what we just talked about now, but in a whole lot more detail.
And
Tuli, I
guys,
don't know if you want to add more.
Can I just
Sorry?
add on that course, and then Tuli, I'll hand back to you. I
Sure.
would really recommend this. So like I say, I've never met anyone who's as good at Johann as sort of cutting through all of the BS around Pillar 2 and explaining it clearly. I had actually booked for this 6-hour course myself, but I just realized I have a clash, so I'm going to have to do the next one. So it's something I would really highly recommend to anyone who has a free Saturday coming up. Tuli, over to you. Your main tips on what listeners can do to start thinking about Pillar 2.
Yes, awesome. I will actually be there next week at Johann's course. So I'm really looking forward to it. But I think what taxpayers should do. The first thing is don't adopt the ostrich in the sand approach. I think look into take a deep dive into it, explore the rules. Like Johann was saying, understand what your potential exposure is, and stay up to date with all the latest developments. And we would love to help you with that. So definitely anyone wanting to get more information and maybe something that's more practical to their business directly, that's something that we are able to help with, and would love to get in contact with any of you and help you with that.
Cool.
Absolutely.
And guys, we are going to send out the slides later today or tomorrow with our a recording of this, which will also be on our YouTube channel, and also with a link to Johann's course for Saturday. It's for Saturday week. Now we have 4 minutes if we have any questions. There are a couple still to go. The one was oh, sorry, just trying to find the can you guys read the chat? There was one question that we hadn't answered.
Is there any sorry, Tuli, is there any reason for having top-down approach instead of bottom-up approach while applying IIR?
Is there any reason for applying a top-down approach as opposed to bottom-up IIR? The simplicity. Simplicity is the real reason, because you only have one ultimate parent. So only they would then do the top-up tax. Guys, while we are talking, I am just putting for you the link for the course in the chat, so you have it there as well. But the big reason is simplicity. From a taxpayer point of view, because there's only one way you do it, and remember, you must have the cash for it, right? The moment you get to lower tier subsidiaries and holding companies and all that stuff, you do get into, do they have the cash to even pay the top-up taxes? That's one issue. I think the other one is also from a government side, and the OECD side is the controllability. Yeah, it's much easier to monitor the large export economies for whether they are compliant and what they're doing than to have to actively monitor a Pretoria of middle and lower tier holding subsidiaries. So pragmatism, basically. Yeah.
Another question: do you believe developing countries might come up with a different proposal under the UN process? Very relevant for those of us sitting in or doing business in Africa.
I don't think so. So let's just go very quickly back. Pillar 1, Pillar 2, right? Pillar 1, the UN has a brilliant solution for it. It's Article 12B of the UN Model Convention. It's a digital service tax.
Yeah.
It is, I don't know, 3 pages instead of 500, right? It is, and it stays where it belongs, with the country where the base is. You will always, I mean, what the UN Article 12B maybe masks is the complexity between sourcing. Imagine for a moment that I am using Momondo or any Expedia or any of those, and I am living in Denmark and I'm booking a flight from Amsterdam to Mexico. Where is that tickets sourced, and where should Expedia pay its top-up tax? Should that be Denmark? Should that be Holland? Or should that be Mexico? Yeah. There are some, or I buy something from an internet service provider who's buying it, and he's sitting in Sweden, and he's getting it from the US and delivering to me. Now, in most cases they simply say follow the end user. But if the end user itself starts moving around, those kind of things become complex. And I mean, that would be a source of dispute potentially under Article 12b, but it is a much more elegant solution than Pillar 1. Pillar 2, I think the UN will be very hard pressed to do better for a couple of reasons. First is a minimum top-up tax is not going to work if you don't have the same tax basis everywhere, because it's going to leave wide doors open for tax planning, right? And the second one is capacity. You know, I mean, the OECD has thrown a huge bucket of money at this. The UN doesn't have that. I mean, I can remember sitting at the UN Committee of Experts where people say you need to realize it's not that we can't book the flights to Paris for the meetings, it's that we cannot afford the books to give to our tax inspectors, right? You know, it's not an equal world out there.
It's a big deal. Yeah. Okay, guys. Well, it is 3:30 South African time. Johann, Tuli, thank you both so much. That was a really interesting discussion for me, at least. Thank you, everybody, for joining. We will send out the slides, the recording, and the link to Johann's course as soon as possible. And all of our email addresses are on the slide. So if you want to contact any of the three of us, please do so. And otherwise, thank you very much for joining today, and we'll see you next time.
Thank you all for joining, and thank you, the guys from Regan for inviting me for this. It's absolutely great. Thanks.
Bye-bye.
Bye now.
Bye-bye.
Bye.